All right, roll call.
Linda Beaton.
Here.
Jermaine Sullivan. Jeff is gone. Doug Parks. Bill Gamble.
Here.
And Ed is out.
Old business, Hound Resources royalties. We have one sheet of paper on that.
So it looks like we have one check that we received. I know Ed's been talking to them pretty regularly, but this is the first one. So it's good we received it. I'm not sure if this is, the total amount we should have received or not. So I'll talk to Ed when he gets back. But it's good we got our first one from them.
Right. Doesn't seem like a lot, though. So. New business. Approval of minutes from August 12th, 2020.
So moved.
Thank you.
Second.
Okay, investment advisor update and commentary.
Could we just all in favor?
Yeah.
All in favor, aye.
Aye.
Thank you. Motion passed. Okay, Woody, we're ready for you. Can you hear us?
Yes. How's the sound on my end?
Good.
Is that
We
good
can
for all
hear
of
you.
you?
Yeah, we can hear well.
Okay. Yep, sounds good.
Okay. Well, I've got Troy and Brian here with me, and if there aren't any questions, we'll jump right into the first page 4, which is kind of the summary of the market outlook. And as you can kind of cutting to the high points on this page is, the good news is stock prices are kind of back to long-term averages in terms of multiples of earnings, and that's a very, very good sign. As we've said in the past, this price earnings multiple indicator might be, perhaps the most important overall metric that assesses whether the stock market is either, high or low, or, cheap or expensive. And right now it's kind of at the midpoint, which is encouraging. It's been over that. It's been kind of what you might call overpriced for quite a while. So the valuations are good. Market expectations seem to suggest that inflation, although it's a serious problem today, will subside over the next few quarters. And so you've got, even though a recession, we might currently be in a recession or one that's starting, the outlook is the stocks are reasonably valued. Inflation will subside. And, that's the positives. The negatives are obviously a lot of threats internationally. Inflation is a big problem. Russia, Ukraine, some recent political developments in China could be threatening or continuing to be threatening. And you never know how this economic decline might precipitate into something, a steeper decline that can be very worrisome. And if we don't get inflation down and you have inflation up and an economy that drops, sharper than we expected, it will be difficult for central banks to bail out the economy with, stimulative measures, because with inflation you don't want to stimulate. So that's kind of a potential threat. We don't think that is the likely scenario, but that would be an outlook that would be, decidedly more negative for the markets. I'm going to turn it over to Troy or Brian, if you guys want to chime in on any of these charts that follow that summary page, which is on page 4.
This is Troy. I'll just mention, inflation has been, our nemesis both on the stock side and the bond side this year. A very rare year where both bonds and stocks turned in negative returns. You see here on this page 5 where inflation has hopefully peaked and begun to roll over, but it's very stingy and it's not going away easily. just to kind of look ahead and talk about what the Fed's got on their plate, their best measure of inflation is what is called the personal consumption expenditure, the core PCE. That number is more like 5%. And so one of the things that their goal is, in terms of getting the economy to slow and for inflation to begin to roll over, is to get interest rates above that core PCE rate, we believe, and that's a little over 5% right now. And that would put the next two rate hikes kind of where they need to be on top of things. That's not to say they won't continue to raise rates a little bit into 2023, just to continue to be tight and to be vigilant against this inflation issue. But I guess the good news is we're getting closer to getting on top of the inflation problem, I believe. And there's a delay. We're certainly seeing the impact in the housing sector already. It's just going to take a little bit more time for these more restrictive policies to slow down some of these rising prices. And so, at some point, as Woody said, we may be in even a recession now or soon. And so, that'll certainly have a big impact on companies' abilities to raise prices and the demand for those goods. So, looking forward to hopefully getting near the end of when the Fed may be raising interest rates sometime in the next few months.
One of the encouraging parts of the inflation story is, I believe about a quarter of the consumer price index is housing related, and you're starting to see a significant rollover in terms of housing prices, rents, demand, supply. Those are all kind of positive trends that might work in conjunction maybe with energy prices and a couple other major components to show better inflation numbers. Troy, did you have any more thoughts on that?
No, again, the wild card a little bit out there's energy and the price of oil and gas and things like that. So there's some unknowns and some risk to our expectations, but it looks like the tightening policy is doing what it's supposed to do early on, and over time it should put the brakes on. And of course, there's always a risk of a harder recession. We're not expecting that or factoring that in dramatically.
Brian, did you want to have any comments on either page 6 or 7?
Yes. Well, move to page 6, and Woody mentioned
Actually, I have a question. I'm sorry.
Evaluation.
Could we hold you for a second? Mayor has a question.
So we expect for the feds to raise the interest rate one more time between now and the end of the year, and then early next year as well? Is that how I should interpret you thinking it going up another 2 times?
You could maybe get closer to the phone, or
She asked if the expectation is one more rate hike this year and then the beginning of next year as well.
I think the expectation is for another hike later in November at the next Fed meeting. So that would be probably 75 basis points is what's expected. And in November, the final Fed meeting of the year, maybe 50 basis points at that meeting is expected. So we're still looking at about 125 basis points of increase before year end. And then, they're getting close to a period where we think they could go a little bit and pause or just cut the pace at which they're raising rates to maybe 25 basis points early in 2023. So there's a few more hikes to go, at least 2 in this year, we expect.
So not being in this business at all, basically, but I know that we have an expert here at our table.
excuse me, what was that comment?
The basis, the 75 and the 50, the 75 and the 50 basis points, how does that translate into what percent the interest rate will go up?
Sure. So when we talk about the Fed raising rates, it's their Fed funds rate, which is short-term, more of a bank-oriented rate. So you look at prime is 6.25 right now. So we would go up another 1.25.
So maybe another look at that would be, I think 1-year Treasury bills, I think are around 4.5 today. So those would go to 5.5 to 6
That's right.
on a 1-year U.S. Treasury bill. That's like a short-term Treasury note. Is that helpful, Mayor?
Yes, is that 1.7, 1.25, the combination of the 75 basis and the 50 basis hike that you're seeing before year end?
Well, we have a hard time hearing that.
Yes,
I think it's yes is the answer, but she was just asking if the 75 basis points and the 50 basis point make up to 125
Interest rate.
interest rate, and it does, yep.
Thank you, Doug. Okay,
All set, thank you. Continue, please.
No problem. So moving to page 6, valuations down to long-term averages. Woody mentioned at the outset, how important that is as far as the outlook for future returns. And for the last 4 or 5 years, the market on a multiple of earnings basis was trading well above 20 times earnings. And for historical perspective, the 25-year average has been about 17 times. So we were significantly above, and the market was very expensive for the last 4 or 5 years. So we're a little bit below that. If you're looking at large cap stocks, this is about 16 times, and other parts of the market are significantly less expensive than that. So that bodes well for where future returns, and that doesn't always translate into returns in the real short term, but generally the stock prices follow earnings over the mid to long term, and we would expect pretty solid long-term returns with these averages, or multiples, I should say. This isn't on the page, but the valuations or yield that you can get on fixed income today is also much more attractive. So that as bonds are maturing, and we talked about how much yields have increased since the beginning of the year, the reinvestment returns possible on the portion of the portfolio are much more attractive than they have been for quite a long time.
Any questions before we dive into the Manistee oil and gas portfolio?
No, thank you.
Let's go to page 9, and you'll see a snapshot of the portfolio here, where as of the end of September, right about at $11 million, we're invested pretty much on target with the target allocation from the investment policy statement. You can see our equities, our fixed income, a little bit of cash. So we're pretty much on target there. You'll also see we have that internal loan. That's an internal to Manistee. It's not something we carry on our books here through the Schwab platform, but it's the loan that was made to an organization in Manistee. And then we'll talk a moment here about the bond portfolio, portion of the portfolio.
Yeah, thanks, Woody. If you look at page 10, you'll see 3 charts and a table. The table in the upper right-hand corner just has some metrics that are worth mentioning. So the portfolio average maturity is just a little over 4 years. So it's what we consider a very conservative structure. Not a lot of long bonds, mostly 1 to 10 year type bonds. The yield is 4.68. I can't recall exactly what it was a year ago, but it was probably closer to 2. So it's really gone up quite a bit this year. You can see the maturity distribution to the left. The portfolio for Manistee is in green, fairly spread out over 1 to 10 years. Quite a bit maturing in the next year, so that, as Brian mentioned, will be, reinvested at those higher interest rates and help us to gradually increase the portfolio yield. Down in the lower left, you'll see the corporate I'm sorry, you see the sector distribution where corporates and treasuries make up the bulk of the portfolio. Mortgages and agency notes make up a smaller portion of the portfolio right now. And over to the lower right, you'll see the credit distribution with a very high grade emphasis on A, AA, and AAA securities. Those largely are treasuries and mortgages, and some of the triple Bs, those would be the corporate bonds for the most part. And just overall, the portfolio is designed and structured to provide, a diversified and reliable income stream for the next several years and to complement the portfolio of equities that Woody and Brian are talking about now. So, any questions on the bond portion of the portfolio?
No, thank you.
Okay, great.
Okay, well, let's move on to the next page, and Brian will talk a little bit about how the common stocks are diversified.
So you can see the equity sector allocation here, and the percentage of the portfolio, and just compared to the S&P 500 is a good barometer of large cap stocks in the U.S. And the portfolio is very well diversified across the 11 different sectors that the market is broken up into. And no surprise here, but and the allocations have been similar here for the last few years. We've had meaningful allocations to sectors that we are finding a lot of innovative companies in with real sustainable advantages over a long period of time in healthcare and technology. But we've also been positioned to have significant allocations to areas of the market that are more defensive, like utilities and consumer staples. And even if you think about sectors that may be more volatile, like consumer discretionary, if we're having an economic slowdown, you'd expect spending to slow down. Well, if you actually look under the hood there, we own some pretty defensive companies like McDonald's, and Amazon's business is really more like a consumer staple if you think about the retail business and some of their Amazon Web Services. So, we think we're really well diversified, and we continue. The focus is to own really the highest quality companies within each of these sectors, and be mindful of the price that we're paying for those businesses.
I have one question. It's just kind of a random question. It's about energy. Do you see in the next few years we're going to maybe increase our interest in having holdings in energy companies? There's a strong push toward, reducing CO2 emissions. Cities are taking advantage of programs to put solar panels, say, for example, on top of their municipal buildings to reduce their energy cost. Obviously, there's a big push toward electric vehicles. I don't know if that would be covered in this, but I'm just wondering if you see any sort of a trend toward investing more in that area.
Were you able to hear that?
Maybe you could paraphrase that.
Just the mayor was asking about trends in energy. I guess not specifically our portfolio, but if you see that's kind of a growing sector with solar technology and things like that. And
I guess our biggest holding there would be a company called NextEra, which we've had for a little while. It's known for two parts of their business. One, they own Florida Power and Light, which is a major public utility down in the southeast and pretty much dominates the state of Florida. But they also have an alternative energy division that is probably the leading supplier of solar and wind in North America, or they're at least a partner in projects to the extent that really exceeds any other competition. And they've been an innovator. They've been a leader. They've been very successful in ramping up that business, and we really like that business, we like the company. But that would be probably the main business. I mean, a lot of companies, particularly technology companies, would be selling supplies chips and software into that industry. But generally speaking, the dominant exposure we would have would be NextEra. Brian, did you have some thoughts?
I'll just add a second point there is one of the larger holdings in the portfolio is Berkshire Hathaway, and one of their the largest companies under their umbrella is a company called Mid-American Energy, and they're probably the second largest wind company other than NextEra. So we really own the two prominent companies within that space, and to a large extent we've avoided the traditional oil and gas companies just because their businesses are really dependent on the price of oil, and that's not sustainable over a long period of time. So we've really focused on some of those newer technologies that have just become much more economically viable over the last 10 years. And we think there's a long trajectory of growth there.
Mayor, I think another comment, we didn't hear your question completely, but the other element to that is a lot of the businesses in this business are not yet established. It would be almost along the lines of like venture capital or new, fresh companies with innovative ideas. And those would not typically fit in with our investment philosophy because we perceive those frequently as high risk, and they're very high price sometimes with a fairly low probability of great outcomes. And so we tend to focus on more established companies that are more dominant, that have proven business models, and that's where the NextEra and the Berkshire Hathaway fit in.
Okay, thanks.
And,
Thank you.
And page 17, they have both of those utility companies. And I think
Yeah.
Next Energy has a yield of like 2.37 for their dividends. So I think like Sunrun was one, but for solar panels, and they did a lot of, I know with interest rates being higher, they did a lot of, you'd have to borrow to get back your money. So a lot of those stocks have gone down, especially with the interest rates going up.
We do have one new company in the portfolio just recently is a company called Zoetis, and that's spelled Zoetis. It's been a public company for about 10 years. It was spun off from Pfizer about 10 years ago, and it's the dominant, very dominant supplier of animal health care, mostly pharmaceuticals, but some services and supplies internationally. And when we talk about animal health care, we're talking about two segments of the animal health care market. Well, one is what we call the companion market, which would be the pet market. Think of cats and dogs and other animals that have various ailments, whether it's dermatitis or all kinds of other things, antibiotics. And then you have what's called the production market, which is animals that supply protein for diets around the world. And Zoetis, very successful business, good growth outlook. We waited patiently for this stock. It was quite a bit higher at one time, and in fact, I think in the last year the stock got up to a very high level, got up to, I think, around 700, $250 a share, and it got down to around 150, and it kind of got back in our strike zone, and we added that to the portfolio, and that's really the only new addition. We've had a little additions and subtractions of existing names, but that's the only big change or new idea introduced. Any other questions on the investment process?
No, thank you.
Let's go on to the next page, which is the cash flow additions. Or actually, let's look at the performance. Performance page 11, you're right. So page 12 is this cash flow history, and you can see this is kind of an update on all the monies that, you know, as the portfolio grows and money is received from some, you know, oil and gas royalties, which have been dwindling, and then the capital spending budget, which is the far right, second from the right column. And this is just kind of keeps it in front of us as to where we are. You know, as I think mentioned in the past, we're getting within a year or two where the total distributions will have exceeded the original fund balance. As you look at the bottom, total distributions so far about $6 million. The next page is the performance summary. And you can see, going back to Troy's comments early on, this is a very unusual year. Normally, we have balanced portfolios like this because the vast majority of the time when stocks go down, bonds go up. Because when stock profits go down, you go into a recession, typically interest rates drop and bond prices go up. But, you know, we're in kind of a unique economic cycle right now where interest rates are going up and stocks are going down. So we have this kind of double whammy, which year to date has led to this 18% decline in the oil and gas fund. And even over the last year, and you can see these, at top line, you can see these various return, once we go out to 3, 5, and since inception, those are compound annual numbers. And you can see, you know, all the comparisons there. Any questions on the performance?
No.
Okay. Well, that's all we have prepared. We'd be delighted to answer any questions or, you know, receive any comments.
And we're reinvesting dividends back in the stocks, is that correct, or is it?
Well, we're not formally reinvesting dividends, but as dividend, I mean, we're not in a dividend reinvestment plan, but as the income is received from stocks and bonds, it goes into the money market.
Okay.
And then we use that to rebalance the portfolio, either with stocks or bonds, or hold it for the capital spending budget, which comes out once a year.
I don't have any other questions. How about you guys?
Okay, I think we're all set.
Great. Well, thanks everybody. Appreciate the ability to serve you. And Kelly, thanks for making all the arrangements and all your support.
Absolutely. Have a good afternoon.
Thank you.
Thank you.
Thank you.
I'll take a motion to adjourn.
Or do we have to get the meeting calendar for?
We have
Oh, meeting calendar. Should've read it.
Make a motion to approve the meetings scheduled for 23. Probably changed, but we'll start with something.
12 p.m. works for everyone? Okay. I'll second it.
Roll call. Oh, shoot. Okay, go ahead, roll call.
Okay. Linda Beaton,
Yes.
Jermaine Sullivan, Jeff Rowe, I'm sorry, Jeff's not here, Doug Parks. Okay, motion passed.
Thank you. Any other things that we want to talk about? No public comment? Make a motion to adjourn.
We're out of here.
Second.
Lack
Oh.
of quorum, the meeting was adjourned. Everybody left.
All right.
I was waiting for Jeff to walk in now, because
I know.
when I got your notice,